Hey, Chris, I don't know if you had the opportunity to look at some of the comments and response, but I was pleasantly surprised at the welcoming. People apparently love our boy Chris Patel over here. So it's very, very exciting to be on another stream, day two, and hopefully we can kind of continue the momentum and see where this goes. But today, Chris, I think I already alluded to you in via DM earlier, a discussion that gets happen that I see happen too much, especially with people that are a little bit younger in their investment career, and it bothers the crap out of me. I'd say it's one of the top 5 things that people say that bothers me. So we might not get into it immediately. I'll kick it over to you, but the thing that bothers me a lot is when people look at the dividends that a company gives, specifically a REIT, and will say the payout ratio is over 100%. Meanwhile, if you actually know how to read a balance sheet, a cash flow statement, you'll know for a fact that it's perfectly fine. So anyway, that's what we're hopefully going to get a little bit in today's lesson today. But kick it over to you, man. It was an exciting day in the market. So
Yeah, man, a lot of a lot of earnings surprises here and there. We've got the funny thing was that rate rise. You would have thought that we would have got a much more, I don't know, like volatile
yeah,
response, but it's pretty muted. But that's probably because, like, there's the theory that, like, if you have news that's already baked into the market, you're not really going to see much things happen, and that's exactly what it was. I don't think this quarter basis point rise was a surprise to anybody. I don't think a single person in their right mind thought that, hey, the Fed was going to keep pausing or they were going to raise to 50. I think everyone knew because this was very well projected. And I also think some of the comments were around by Jay Powell were somewhat dovish. So that probably helped a little bit too. So both of those things in combination just, yeah, there was a little bit of like a movement here and there, but everything just kind of normalized.
it
It's
went
very
from like
interesting to see.
minus zero point 0.2 to plus zero point 0.2. It was like you said, plus
Yeah.
point. So it's a half a point move. So it's not even that big of a deal
Yeah.
in the grand scheme of things. Normally, I'm used to it dropping to like 445 and then going up to 460, and so it was definitely more tame than I was expecting for sure.
Yeah, I mean, at this point, we can safely say that this rally has some legs on it. A lot of companies are reporting really good earnings, so I think some of the changes in the interest rate side may not have impacted them as much. But then there's also this theory that I have that I think a lot of companies they're pulling a they're using the one trick up their sleeve, which is cost cutting, right? So what it is if your earnings in terms of revenue growth are not that great, you can cut your way to profitability and to EPS growth. And when you do share buybacks, you can, make yourself look a little bit artificially like, like a good value proposition. The thing is, like, future growth is going to be the thing that really determines whether or not you want to be in it. So I think some of the companies that really get a lot of the headline attention, they came up with really good numbers, and so I think that might have filtered through to everybody. But I'm worried that these weaker companies that are also rallying at the same time are um, they're being given a lot of premium in terms of in terms of valuation, and believe it or not, they do not deserve it at all. But this is one of those things, man. Market sometimes can be irrational longer than we can stay solvent, so it's not worth taking some unusual steps on the downside.
Mm. I think you're right. I think where people, not specifically jumping into real estate as of yet, but talking about a lot of how loans and bonds are coming due and having to say pay them at a higher interest rate. What you would see is some companies, I'll use Apple as an example, but everybody was doing it. They would borrow at 1 to 2% and buy back all these shares, and now they're just sitting on a bunch of debt that's worth 1 or 2%, and now it's getting to the point where some of these debts are rolling off, and companies were, like you said, able to artificially inflate their EPS to make themselves look good, but in reality, you know, the revenues didn't grow as much, or the dividend growth wasn't necessarily as strong as you would anticipate, because they were artificially financially engineering basically the company and the balance sheet. So I think it's pretty interesting in that respect. I think a lot of people have seen that in the real estate piece, because specifically for REITs, they operate very much like debt vehicles versus say a C corp or something the like. I mean, they'll get bonds and they'll be where, you know, they'll have to repay it 5-10 years from now. So it's a little bit different of a story. But I'm curious that if we stay in this sort of elevated, you know, not, I mean, with this 5.5% interest rate, we're back up to where we were back not since 2001 timeframe, which I thought was pretty crazy. But now the fact that you are going to have to start paying these inflated bond prices, I'm curious when it's going to start catching up. And I think you hit the nail on the head with respect to, we have already started to see some of these companies slow down, and you know, some of these dividend specific stocks have definitely started to kind of take a hit. But anyway,
I mean,
were
you know
you going
what?
to share something?
I was, but then I was like, I'll do it at the end. But
Yeah,
one of the things I was gonna just say, you know, it depends on the asset class. The asset class that's out there, some of them have dividends that are very safe just based on the intrinsic nature of their operating structure. You know, they have room where they can cut here and there and maintain the dividend. So it's like one of those things that you just have to analyze individually at the company level. And you know, if you do the work, it's actually not that hard to figure out who's going to cut their dividend and who's not. You know, if someone's liabilities are, you know, so staggering that now their refinancing is coming due, where they have like a maturity wall coming up, what you're going to see is, you're going to see, you know, them shift from paying out dividends to paying down debt. That's just a normal part of part of the cycle. And then when interest rates start getting cut again, they do the same thing in reverse, where they start to, you know, refinance into lower debt and then use some of the savings to pay out a higher dividend, right? So I think what it is dividends are a way to rewarding shareholders, but it doesn't necessarily mean that that's always going to be the case. There's a lot of great companies who've cut their dividends, and they're doing it because that's how you're supposed to prudently run the business, because you want to run it for long term. Now, the thing is, though, when what we're going to about to talk about is REITs, and for those that don't know anything about REITs, let me just quickly, you know what? I'll let you do the explaining, and then I'll chime in a little bit. Um, so, can you first explain to everyone what a REIT is, and then we can go on from there? Because I think once we understand that concept, people will appreciate it.
for sure. So a REIT is a real estate investment trust. So it's a debt, basically it's a company that's structured for a debt vehicle. I think it's like more than 100 people had to be invested. 90% of the distributable cash flow has to be kind of returned back to shareholders.
Profit. It has to
The
be
profit, the net income.
profit. Yeah.
Yeah. So I think this gets people somewhat scared because, and this kind of goes for other companies as well. Um, when you have very capital intensive businesses, the government will entice you, or at least give you a little bit of alleviation in terms of how much taxes you have to pay due to depreciation or amortization or depletion in the case of oil and gas or minerals. But in this case, because you're investing so heavily into something that appreciates over time, and you know buildings have a useful life, and you know you have to continue to upkeep them, they give you a little bit of a tax break, which is called depreciation. And so when you kind of look at it, you get a net operating income, and we can kind of walk through a cash flow statement a little bit later. But people will immediately kind of look at the net income, which is heavily impacted by depreciation. And this goes for any company that has high DD&A costs. So oil and gas is the same way. I wouldn't be surprised if railroads are the same way. Any company that is very capital intensive will operate in a very similar manner, where they're able to get a little bit of a tax break. And so what people end up looking at, and it's very easy to go on a website and look at what payout ratios are. And generally speaking, payout ratios is like a simple way to look at things, which is, well, how much net income was there, and how much are they distributing as a dividend? And you take the dividend, divide it by the net income. And if it's over 100%, it's unsustainable, right? Don't invest in it. Don't stay away from it 100%. And a lot of people will go into Dividend Seeker or Dividend Tracker or anything like that, and start typing in some of these REITs, and they're like, oh, I'm staying away, or oh, I have a price to earnings ratio of $50 per 50x, right? It just doesn't make sense when you start looking at these things. So I've had so many people over the past 10 years. And I got fooled by this as well. So I'm not saying, it's unique to me or like I've always known it. It's something that you just have to learn. And I think not only before I hand it over to you, I'm sure you've had some notes that you want to tie on to. This is a good thing to think about because it goes to show you that not every company can be evaluated the same way. Whether you're looking at real estate or you're looking at some of these speculative positions that Chris might be bringing up in Finance Junkies. And so every single industry, it goes back to the due diligence piece of making sure that you put in your time and effort in researching and thinking about, hey, this is some sort of industry I've never invested in. What are the key components of this industry that matter? Like if you're looking at tech companies, monthly active users is a big thing. Or if you're looking, so those key metrics that truly matter to each individual industry. In this particular case, funds from operations, which removes some of that depreciation costs and allows you to kind of understand what the distributable cash flow is for investors, is truly important. Chris, what did I miss?
You didn't miss much. The only thing I would say to add on to it is that, as an investment, um, always make sure that you're doing it in an account that's going to yield the maximum return for you, right? So one of the drawbacks to investing in REITs is that you have to pay the dividends as ordinary income. So if you're already in a high tax bracket, what you're going to end up doing is, like let's say your taxable income is like, I don't know, like in your higher tax rate is like 30-40%. That means that just because, even though if you're getting a 10% yield, which seems really enticing, 40% of that's going to end up going back to Uncle Sam. So it makes no sense to hold it in a non, in a taxable account. On the other hand, if you put it into something like an IRA, whether it be a traditional Roth, none of the taxes that you're going to have are paid. Like you don't have to pay any of them because now you have a tax-free vehicle. So when you're investing in companies like that are REITs, you have to know two things. You have to, one, know how to evaluate them, not just based on the same metrics that you would do to a normal stock, but then also how are you going to profit from their growth and from the returns that you're going to get. So I would say, like right now, um, a lot of times people will buy REITs in their regular account, and it's like, and at the end of the year when they get hit with the tax bill, it's like, oh my God, like what the hell? Like have to pay so much in taxes. And it's like, yeah, but if you had just instead opened a Roth IRA, taken the same money, put it into a Roth IRA, and then put that into a Roth IRA, your income would have doubled. And not to mention the compounding part of it is what lets it even grow further and further and further. So if you think about a REIT, most REITs, if you do them right, they can compound to be like some really big returns. And you get a couple of really big benefits with REITs that like you don't typically get with other industries. One is that if the business is cash flowing, you know that you're going to get that return. You're going to get that dividend. It's not one of those things that it could just be cut off. I mean, it can be cut off. I'm not saying it can't, but the likelihood that it is not going to be there. So if you want to invest in a profitable company and you're leery that, hey, I might get like my dividends cut off, then REITs might be a good way to go. And it's the same thing for like people who are, especially people who are retirees. Like imagine right now you have $1 million in your portfolio, right? Like you have $1 million stock, or you just sold your house, you have $1 million. You're like, you know what, I want to live a good life, and you take on and you buy a basket of REITs, which is the smart thing to do. So you're diversified, right? And because you have no income, you're relying on that income to come in. Now the thing is, if you're diversified, even if the REITs, like even if the returns start to like waffle a little bit with some companies, others will make up for it. So you wanted to structure your portfolio so that you're going to have like a whole bunch of these companies that are yielding a good amount, and literally you can just retire. And every month, some of the newer REITs that I'm looking at these days, they have monthly income, which is awesome because before you had literally quarterly and sometimes even semi-annually. And the only thing is with REITs, I would say that there's even one more safer vehicle that you could do, not REIT specifically, which is bonds, corporate bonds. So if you're willing to take a little bit of a step back in terms of capital appreciation, and you do your homework, you can actually buy a corporate bond fund that pays really good dividend, well, good interest. It's not called a dividend, it's called interest. And once again, it provides for a nice stable retirement. And the difference between a dividend portfolio and a bond portfolio is that the bond portfolio, the bonds, like companies have to pay out the bond, regardless whether or not they're losing money on a net income basis or even from a profitability standpoint, because it's actually physical debt. They have to make those coupon payments.
So
And so,
put it for example, say Apple cuts their dividend, right? That's stuck 20 years from now, but they have a bunch of bonds out. They have to pay, even if they cut the dividend, they still have to pay the bond interest. If they don't,
absolutely.
that's when they either have to reissue more bonds to be able to pay off the old bond holders, debt holders rather. And if they don't, then they have to declare bankruptcy. Those people get first rights in terms of if the company gets dismantled, sold for all the pens, pencils, paper, computer infrastructure that's within the company. Those are the people that get first rights. But Chris, you said something. You said a bond fund. When you said bond fund, did you mean actual bonds or did you mean the bond funds? Because I think some people, they'll buy like a treasury bill ETF or like a treasury bill fund, and they'll be like, I thought my principal never moved, but yet here it is going up and down over time. So can you explain a little bit?
Yeah, so it's the same thing as like an ETF that holds stock, but instead they just hold a whole bunch of bonds, right? But the way that they do it is that they layer the bonds so that this way you're getting like some sort of stable return, right? So when you look at I'm trying to think of a few that mirror that, but like TLT, not TLT, like some of them are specifically treasuries, but then there's other ones that are like more based on corporate debt, right? So basically they only invest in corporate debt. And then you have on top of that, you've got other companies that will invest in honey, you're like distracting me.
We're gonna bring you a snack.
Thanks, dear.
Thanks, Mom.
Chick-fil-A. Can't say no to
Ooh,
Chick-fil-A.
good choice.
Thanks. So yeah, I lost my train of thought.
Good, man. Chick-fil-A
Yeah,
makes
so
everybody lose their train of thought.
yeah, what they do is they invest in different layers of debt in a company, and those can actually end up yielding even a higher return at a safer rate. It's just you just have to know which funds to invest in to do that. And we'll over time in this specific podcast we'll go over that, because that'll help everyone understand like what the risks are, how you're supposed to value some of these companies, when things go under book value, how really great opportunities those are. Because when it comes to investing in companies that are dividend paying, when you see companies drop way below their book value, that's, to me, that's amazing, because that means that there's some level of market was that market irrationality that you can actually profit off of. And yeah, and if you're willing to actually do the homework, it's actually really nice. It's really nice.
Yeah, I definitely want to get, because I know you're a little bit more educated about the bond market than I am for sure. And I'd like to get you and pick your brain. And initially, when I was kind of teaching myself about bonds, I initially thought this is how you calculate them, and they're all very interest rate dependent and all that stuff. So I'm very, very kind of curious. I've now gotten a little bit more educated on it, but I know you've done a lot more bond purchasing than I have, specifically corporate bonds. But hopping into specifically maybe a little bit more about what we were talking about earlier, I'll pull up, and I don't know if you have your company, if you have a company that you wanted to preface as well, but I'm just going to pull up a company that is near and dear to my heart, because I have had a position in this company for, I would say, going on since 2015, so like 7-8 years, and I've added more over time. I bought initially 100 shares back in like 2015, like the $18 and $19 range, and it's now grown to about $38 a share. And I think it's done really well, mostly off the back of being a triple net leasing warehouse industrial REIT. So I probably flip flop those words around a lot, but it's basically a warehouse REIT That's triple net,
Well,
meaning they don't have
yeah, I was gonna say explain that part because that's important.
they don't have to the owner of the property, the warehouse, doesn't have to pay for the property tax, doesn't have to pay for the maintenance of the property. And what's the third one? What's the third N? I'm trying to remember. They get the normal rental income. They don't have to pay property tax. I don't think they have to pay for property management. Basically, they own the
Insurance.
warehouse. Yeah, they basically own the warehouse, and the only thing they have to worry about is if the building burns down. And the only thing they pretty much have to worry about is what they bought the building for, what the rent escalation is per year, and things alike, and making sure they maintain the tenants.
And insurance. Don't forget about that. So this way, what happens is you don't even have to worry about it burning down because the insurance is even covered by the tenant. So
Really?
you go to you ask the tenant like, hey, you're gonna have to have insurance because remember the insurance portion of it, the organization, depending on what they're doing in your building, is going to have to be adjusted based on that. So if you have like, I don't know, you rent out space to a data center versus something that's just doing like storage, they're two different things because it's a higher chance that you're going to have a fire in a data center. Yeah. So even the insurance portion is covered by the tenant. So the tenant covers the insurance, taxes on the property, maintenance on the property, and anything additional like to just maintain the property.
I had no idea the insurance was covered. Okay, for some reason I thought that the owner, but okay, the more you know. Every day you learn something new. But what I want to highlight, this is a monthly dividend paying company. It's one of the reasons they got attracted to me in the first place. I think I learned about it first on Seeking Alpha back in the day, and then I also used to follow a guy called Dividend Mantra. Now on Twitter or X, he goes by Jason Fieber. And I think he also was a person that was investing in Stag way long ago, talking 7-8 years ago. And so I followed him into it and I was like, this monthly payout, this seems pretty enticing. And it seemed like it was a pretty good deal. But anyway, these are the type. I'm sure if you drive outside of a major city, if any of you live in a major city, you see these big ass buildings. And this is pretty much what they're looking for. But this pays about a 12-cent dividend on $38 stock. So 12 cents a month and ends up being about $1.47 a year. And so initially, if you were to kind of just, let's cut through all the bullshit. You look at the statement of operations, the net income statement, make 171 million, yada, yada, yada. Basically, where I want to get to is at the very bottom for the 3 months ending second quarter 2023, the EPS was just under 30 cents. Well, you'd probably sit there and say, 12 cents times 3, because 3 months and a quarter gets you to 36 cents. There's no way this company's going to maintain this dividend. There's no way. It just doesn't make sense, right? I mean, they'd either have to go into debt, they'd have to sell off assets. But a lot of this is very dependent on what we were talking about earlier. There's $68 million in a non-cash event. It's basically to basically help lower the amount of taxable income on this particular thing because they try to avoid paying taxes at all costs because it's a REIT, and they do that by depreciation. They do that by distributing funds to shareholders. They have to distribute 80 to 90% or whatever to shareholders. So in reality, and Chris, then you can kind of correct me if I'm wrong. If you start looking at it, they think they made like 50 or 60 million in net income. If you add back in the depreciation costs, they start taking out, on the next sheet, you look at specifically some of the CapEx and stuff that they have to do because they have to kind of add stuff to the buildings if they really want to make them more attractive for people to rent them, what have you. Then you end up getting a core funds from operation of 56 cents. So 36 divided by 56, obviously it's a good enough payout ratio where you can kind of continue to pay that out without any sort of problem versus what people might initially look at, which is payout ratio, which is the dividend divided by net income, which in this case is just under 30 cents. So that's one of the big things that I wanted to highlight today. And this is something that you could look at. Oil and gas is very similar to this. If you look at oil and gas dividend payouts versus their net income, you'd probably sit there and say, holy crap, there's no way that this oil company is able to maintain this dividend. And sometimes that's for cyclical price reasons, but sometimes it's obviously also because of depletion, depreciation, and amortization. So, Chris, I don't know if I missed anything there, if you have anything to add.
No, I think you nailed it. The only thing is, when it comes down to profitability, management has a way of kind of like moving things around in their debt structure that if they time things right, it won't ever impact the actual like dividend, right? So basically what it is you have to layer on the debt so that this way you don't have any maturity walls. Because right now, a lot of REITs, they have this problem where they have a lot of debt that's coming up that's due for refinancing. Remember, just because you own the building, where did you get that money from? Well, you had to borrow it from somebody, and usually it's borrowed from banks. It's usually borrowed via private investors. So as private investors, they have a time where they get their money back and you have to refinance it. And these things are not like you can issue a 30-year mortgage. There's going to be a certain amount of time, typically 5, maybe even like 8 years. I don't see too many longer than that. But basically, if you are at a point where you issued all this debt to finance buildings or finance projects, and they were all done in, let's say, 2017, 18, 19, when interest rates were super low, and all of a sudden now the rent, I mean, you're still getting the rent and it's increasing, but that whole debt that you issued to build all this stuff comes due in 2024. That could be really bad for your business, because now what happens is the interest that you were paying might have been like 2, 3, 4, and 5%, and now it's going to jump to 7, 8, 9, and 10%, and that is really bad. So one of the things when you're investing in REITs, always look at the maturity schedule, just like Matt has pulled up, and I'll actually explain how each one of those what the difference between each one of those debt structures is, right? So if you look at 2023, this means that they have $3 million of debt maturing. That's literally like a nothing burger. It's just going to come right off the balance sheet. Not a big deal. Like any cash flow, 3 million, boom, done. 2024, same exact thing. $50 million for a company like this size, not a big issue. It's going to just be paid off. On the other hand, 2025, you're starting to see a higher number. Now, they were able to issue out that debt at much more favorable rates than they're going to be able to get today. So if you look at bottom, the weighted average interest rate, that's how much interest they're actually paying on that right now. So it's only about 3.4%. But let's say in 2025, they have to refinance all that debt. They can do one of two things. They could say, well, you know what? We're gonna have to pay off this loan, so we're gonna take our cash flows and pay off the loan, or we're gonna get new debt. The new debt, though, is probably gonna be around 8-9% interest rate, and that's really bad because now that's gonna impact your bottom line and your cash flows. So that's where companies have to be prudent in figuring out how they're gonna layer this whole maturity debt structure. And right now, the whole concept of interest rates are going to be higher for longer should scare the shit out of most REITs, because most REITs probably didn't project that they would have to pay this much additional interest in such a short period of time. The good companies are figuring out how to address this. And most of the time, what they'll do is they'll do something called an asset sale. So imagine right now you have a portfolio of 20 buildings, right? Well, one of your buildings may be worth $300 million to somebody. So you might say, you know what? I would like to keep this asset because it's cash flowing me, but I don't want to end up paying 8-9% mortgage on that specific property via the debt. So what I'm going to do is I'm going to sell that property, use that money to when 2025 comes, put it right into the debt and just clean the debt out. And now I don't have to worry about anything until 2026. So it's almost like live to fight another day until the rates can come back to normal again. I think you're on mute, Matt. You're still on mute, Matt.
I double clicked it. That's pretty much what SLG just did, right? They just sold one of their buildings 49% share to be able to get about $1 billion worth to pay off some of that interest or debt that they had. So companies like that, and that doesn't go just for REITs, right? That's for any sort of company. They all have debt schedules, and there's different types, right? You saw on that specific sheet there was revolving debt, there was secured notes, unsecured notes. So all that stuff, is very pertinent to understanding, well, what kind of debt is it? Is it something where they have to go back to the market? Is it something you can just pay down? Is it kind of like a credit card, or is it kind of like a corporate loan, right? So that stuff sort of means a lot as well.
Something that a lot of people don't understand, that it's really worth, and even people that are in certain sectors don't understand this. You can have debt that's something called non-recourse debt. Okay, so a lot of people are right now saying commercial real estate is dead. We don't want to touch commercial real estate. And I'm like, okay, well, do you know that most of the buildings that these commercial landlords have, they actually are non-recourse loans, right? So the loans are actually held by the subsidiary corporation, but what it is the building is actually what gives that mortgage that's secured by it. So let's say right now I have a property, I have 10 properties. 8 of them are cash flow yielding, 2 of them are not, which means that, the tenancy has gone down, the occupancy is low, everyone wants to work from home. These 2 buildings, they're older in my portfolio. I've had them for the last 20 years. I don't think I'm going to be able to generate any additional cash flow from them, but I still owe, let's say, $200 million on each of those properties. Well, I could just say to the bank, well, you know what, Mr. Bank, here you go. Here's the keys. Take it. I don't really care. Blah, blah, blah. I take a $200 million write-off on my balance sheet, but I don't have to worry about that debt anymore. It's completely gone, and it's the bank's problem. It's the bank's issue to worry about. Now, this is where it's really interesting, because a lot of times the banks will say, I don't really I'm not in the business of becoming a landlord. And if I try to sell it, I'm going to have a hard time selling it in a crazy market. So most of the time, lenders will actually work with you to extend out that debt. So a lot of REITs right now, what they're doing is they're actually going to the banks and saying, look, either you give us better favorable terms right now, like extend out the loan. So let's say the maturity was in 2024. They could say, well, you know what, we'll pay a little bit additional, but we want the debt now to mature to like 2030. Now, most banks will say, look, I'd rather have my money back. But some banks understand that, hey, something is better than nothing. So we want to make sure that we work with these guys. So what they'll do is they'll extend out the debt. And so SLG actually did that with one of their buildings as well, where they actually were able to work with their lenders and say, look, I know I owe this money to you and it's going to be coming due soon, but give me more time. And this way I'll keep the property, I'll redevelop it, I'll make sure that I'm able to pay you in the future. And so a lot of banks, they don't want to take that hit up front right now, because the last thing the banks want is a lot of write-offs to happen all at the same time. So I think a lot of people have pretty much forecasted the demise of commercial real estate, and they're all wondering, when is it happening? When is it happening? And I'm like, it's not up to the REITs. It's actually up to the lenders and what they want to do.
Didn't I'm trying to remember if I read this appropriately. Didn't one of the partners basically stop paying part of the note on one of the properties at SLG, and SLG actually took it over just so that they could get it off their books? I forget what partner that was, or if I misread that.
No, there was a whole thing with HNA. We can go that into the future, because I think SLG is one of those companies where if you really deep dive into the business and some of the stuff that the actions that they've taken, they are a smart shop. They are just brilliant. The way that they structure their deals, the way they redevelop themselves, the way they even layer on their assets, and they're just high quality assets too. So it's just a very
trophy properties.
Company. Yeah,
trophy properties.
And it was such a steal when it was $20. Man, me and you were I was like, Matt, you know your stuff when it comes to dividends. You need to take a look at this. And I'm glad you got in. I got in.
My only sad part is I trusted you. It didn't make sense to me when you told me about it. I was just like, okay, sure, I'll look at it. You poked me lightly. It wasn't like a hard poke, but you were like, hey, did you get around to it? And I was just like, it's like I'm just sitting on my couch. I was like, let me take a couple hours. And I looked at it and I was like, I don't understand why it's trading this cheap. And I kept looking and diving deeper and deeper and deeper. And it just made sense. My only problem is I didn't buy more. And my only other problem was like I thought about it. I was just like, maybe Chris is really onto something. And I was like, should I buy options on it? And I didn't. I was like, I should buy half options, half. And I was like, no. I was like, I'll wait. I'll collect the dividend in the meantime. And I didn't expect the turnaround to happen this quick. And I still think it's got a long ways to go, but it's in the mid 30s already, and I'm up like 50% or something like that compared to where you mentioned it to me. And you got in a slightly better price than I did, I think, as well.
I got it almost at rock bottom in the 20s. There was actually a point where I actually sold, and I sold it at a higher price, and then I sold a whole bunch of puts, which ended up expiring, and I was just sorry, and I was just like, this is just too good. My brother actually bought, like, I can't tell you the amount, but it was in the six figures, and he's done exceptionally well because he was asking me last year. He's like, I have all this extra money. Should I buy an investment property? And I said, do you really want to deal with the tenants and the headaches and stuff like that? He's like, no. So I was like, look, you should take a look into some REITs. So I had already been searching for good REITs for him. And when this came up, I was just like, look, man, this is the risk that you're taking on, but this is a good company, blah, blah. He just went all in on it. And I didn't tell him to go all in. I told him to be measured, but he's like, fuck that, let's go. And so right now he's sitting pretty, and he's getting a nice monthly check. That's just crazy. Like it's really cool to see when
I don't know how to respond to that.
I you know what? I'm gonna unplug Alexa, dude. I don't know what's going. Sorry, I don't know what's going on with Alexa, but like
she's always listening, man. Jeff is always listening. But no, when you kind of presented it to me, I was looking at the yield on it, and I was like, and I already had WP Carry, which is another triple net real estate property. They kind of do a little bit across the U.S. I think they've started to move a little bit to Europe, but I was like, I think the upside on this is pretty limited comparatively to what was going on with SLG. And I saw the book value, and so I was like, this has a lot more capital appreciation to it as well. And so I took the leap, and I'm glad I sold out of WP Carry, which has still kind of remained flat, if not gone down slightly compared to SLG. But we don't have to make it all about that. I'm sure we could dive deep into what you saw and why it was such a good opportunity in the future. But I don't want to hold you. I don't know if you want to keep these to 30 minutes. Eventually,
I want to apologize first to everyone. This is like my first meal of the day. Actually, I had breakfast with them, with the missus, and then after that, I had this, and that was it. So my wife was like, "You really need to eat before you get some rest." So I'm sorry, I didn't mean to eat on stream. I'll try.
Dude, don't apologize. If you look at these gamers and stuff when they stream like 6-7 hours a day, they eat on stream all the time. And you just got off of Finance Junkies not too long ago. So don't ever apologize. And especially Chick-fil-A when it's cold is not bueno, man.
Dude, Chick-fil-A's waffle fries just do it for me, man.
Oh,
I don't know why. Like, I don't like some people like live by McDonald's fries. I'm just like, bro, y'all haven't had Chick-fil-A waffle fries. Like, have you ever flown into Atlanta, the airport?
Yes,
dude,
it's a nightmare.
When you go to like Terminal C, that's where the Chick-fil-A that I usually fly out of Southwest. So there's always a line around the block. Like, if there's one company, if they ever IPO'd, bro, I would sell. It's Chick-fil-A, man. But they will never IPO. Never. No. It's they'll keep it small.
They don't want to adhere to the shareholder, like Vanguard, BlackRock. Like, this is what we want for ESG, all that wokeness. They don't want to deal with any of that. I don't think Palantir wanted to either, but I guess somebody made them do it. Anyway. But in the future, I know we talked a little bit about the lesson, and Chris, you can correct me if I'm wrong. I don't want to necessarily bring people on stream unless they're really comfortable with it, but I definitely want to answer more questions, especially once we start getting a larger
Yeah.
audience.
Let's do that. Let's take the next 10, 15 minutes, just answer some questions. If anyone has questions in your comments, let's highlight them and let's answer them.
Yeah, or topics, right? Because I really
Yeah.
want to kind of be something. There's so many different intricate things that you can kind of cover that I feel like sometimes, because we're trying to cover so many topics, or at least like FJ tries to cover so many topics, that you get cut off almost, and you either have to create a separate episode about it or talk about it on Twitter or something like that. So, but one of the things I also wanted to kind of bring up was somebody in the comments earlier mentioned JPQ, JAPQ. And for those of the people that don't necessarily understand what that is, it's mostly technology focused. It's probably, I don't remember exactly. I get some of these covered call ETFs wrong. But those are also ordinary income dividends. So make sure if you do hold them, along with master limited partnerships, which I didn't mention earlier, and REITs, make sure you always hold those in a tax sheltered account if possible. I know it's not always possible, but if you think about it, Chris said it perfectly earlier. Say some of these high yielding covered call ETFs, which puts principal at risk, by the way, over time. But if you're a yield kind of guy and you have it in a tax advantage account, it could literally save you 3-4% on that dividend yield that otherwise you would have to pay at the end of the year in taxes. Like some of those things yield 10, 11, 12%. And if you don't have them in a sheltered account, you're going to be paying 3 to 4% of that 12% to the government right away. But anyway, Chris, I don't know if you have any thoughts about covered call ETFs.
Yeah, you know what? They're very new to me. I didn't even really look into covered call ETFs as a viable investment, because I was just like, you know what? I have different asset classes that yield the same amount. Like, how safe are they really? Like, what like, are they making money just based on like increased levels of volatility? You know, what happens when volatility goes down? You know, and JetBQ seems like a very, very well run, ETF. You know, it's definitely something that's worth looking into. But once again, it's something that if you're retired, if you're semi-retired, which means that let's say you quit your job and you're working part-time, or you're in your 30s, and I don't know, if you're in your 40s and somehow you were able to accumulate a good amount of wealth, this is a perfect way that you can retire early. Because what happens is now, because your income is next to nothing, you want to have some level of income coming in to basically finance your day-to-day life. So as an example, I know a friend, he had inherited a home in Pennsylvania, and you know, it was a really nice house that his grandparents had bought a long time ago, and he was like one of the only people left. But basically, he could have sold the property that he had, that he inherited, and basically took the money and did something with it. But instead, he asked me, he's like, you know, like, I'm gonna sell the property. What am I gonna do? You know, I'm gonna need a place to live. So I said, look, man, here's an idea. So right now, interest rates are super low. Why don't you go get yourself, put a mortgage on the damn thing, because the mortgage was paid off, because you're getting like 2.75%.
Right.
Take that money and then, you know, put it into a dividend paying REIT. You're pretty much not working at this point. You know, you're looking for a job. Why don't you just turn that into an income source, right? And so what he did was he got a loan. He turned that into, he got the money from the mortgage for that, put it into a REIT, is now getting income from that, and now he's actually renting the place out on Airbnb, right? And so he's renting it out, like not the whole thing, but like individually, like rooms and stuff. And he's like staying in one part of the house, and you know, he's got the whole thing set up where they have like a separate entrance. Dude's retired. He's a young guy, you know. And these are the kinds of things that, like, if you are willing to learn, you know, you could very well retire in your 30s and 40s. I know plenty of people, you know, if you have enough of a money nest egg saved up, and you know what you're doing with regards to dividends, with interest and stuff like that, to eke out a 7-8% is not hard. It's really not.
Yeah, and it goes back to kind of like, I think I've talked about it a little bit on my channel specifically. It's like in 2021, I honestly thought about hanging up my work boots. And at the time I was like 30, 31. I was like, okay, I was like, I'll be making 60, 70 if I really kind of wanted to be conservative. I wasn't going for those 11, 12% yielding but I was looking at some of the things that were yielding like 6-7%. And I was like, it's like, I honestly could do it, like if I wanted to. But at the same time, I'm like, is that really where I want to level off at? Right? Because some of these covered call ETFs or some of these higher yielding ETFs, it's like sometimes the growth rate of those isn't that great. Right? And I'm not talking about the SCHDs or the VYMs of the world. I'm talking about like the JEPI-Qs and stuff like that. The sometimes you have to recognize, I think a lot of people, they'll look at JEPI and they're like, oh, well, it's based off of, let's just say, the S&P 500, for example. And then they just pay a high yield on top of it. So it's like the S&P 500 goes up 20% and this pays 12%. I'm going to walk away with 32% for the year. It's like, no, my guy, that's not really how it happens. You have to think if it rises very slowly over time, you'll be okay. And JEPI will also do okay. But say it jumps up, say the S&P 500 jumps up 5% in a month. There's a reason why they wrote that covered call. It's for the income. So it might cap you at 1.5% for the month in terms of the capital appreciation, but it might give you out 0.5% in dividend yield or something of the like. So overall, the SPY might have jumped 5% that month, but you only got 1.5%. And so if you look at these the principal or the return of the actual stock and share price themselves, they'll always kind of be flat and slowly trending upwards. Then you have a very large drop off when you have some of these recessionary periods. And so just be wary, right? Understand it's like, what game are you playing? Are you playing the income game? Are you like this gentleman who just wants to kind of retire, live at home and not really work anymore? Or is it something where you're still trying to grow, right? Play that balance, understand what's going on. Don't just be like, oh shit, free 12%. It's like, it's not really it at the same time. It's like that 12% is probably over 5-10 years is probably going to be the only income that you're getting or return you're getting, because eventually there's going to be some 5-10% recession that immediately wipes out several months worth of capital appreciation. Chris, I have another one on the screen. I don't know if you want to rebuttal to that or move on to the SLG dividend.
Okay, let's go. Which one? Is that the MLP question?
The SLG dividend.
Where is that? Oh, yes, it does grow over time. As rents grow, so does the dividend, right? The thing is, though, it's all going to be dependent on the assets themselves right now. So a lot of people are saying commercial real estate is dead, so getting financing for new commercial real estate construction is going to be really hard. But existing commercial real estate, if in the future there's no demand, then rents are going to, of course, have to increase. So right now there's like a supply and demand thing going on. So, but yeah, I think SLG will eventually increase their dividend. Believe it or not, they may even decrease their dividend a little bit, because if they're selling assets, that means that that's not income that's being produced next year or the year after that, right? So you could very well see a decrease in the dividends that are being paid in the future. Now, what does that mean? Well, it means that instead of the 10% yield that you may have right now, you might have to live with a 9% yield for a short period of time. And what's good about that is that means that the management is at least taking some prudent actions in addressing their cash flows. Because if you have a management that's like, fuck it, let's just pay the dividend until we die, that's really dumb too, because you don't want that. You don't want you want management to have a balanced approach when it comes to doing dividends, where they're not actively cutting dividends all the time, but they're not also taking unusual amounts of risk that you end up losing all your money on, and that's what happens. Sometimes companies will over leverage themselves, where they're so hell bent on growing that they will just they'll buy a building and then they'll buy another one and then they'll buy another one. And before you know it, they have a huge portfolio of buildings, and one bad recession comes, and now all of a sudden everything just it's like a house of cards. Everything collapses on itself. One building can't pay. They try to do negotiation here. Another occupancy drops over there. And literally they start fighting fires the entire time. So you want a company whose growth prospects are there, but they're very well stewarded through all the hard times, So.
Some companies, like you said, I mean, let's just say you get $1 billion worth of real estate, or $1 billion worth of funds from the market, whether that's bonds or what have you. Some people might go out and buy a lot of properties at a 40% loan to value ratio. So they'll have 40% of the principal, but the other 60% is mortgaged. But then other people might be, I guess, wanting to leverage themselves more, because if the capital, the property appreciates, they're going to get much more leverage, and they might buy 20% loan to value. And so in that respect, it's like they basically have a loan on 80%. Yes, they might increase in value in the short term, but if there's a bad market, like you said, you're going to be stuck with twice as much debt. So you have to kind of look at where companies play their debt to EBITDA ratios and all these other kind of things to understand how much financial engineering are they doing with this background growth, right? Because some companies are very much like, let's pay no debt or have no debt. We don't have to worry about it, like Palantir. And then some companies are like, well, if you increase your debt by, say, 20%, you're going to get another X amount of internal rate of return. So let's just do that. And so that in a down period might be very dangerous, like oil companies, for example, very capital intensive businesses. When capital's cheap, they get a lot of debt because it's only 2 to 3%. Makes a lot of sense when the oil price continues to go up and the inflation of oil field services and everything like that. But when the oil price collapses and oil field services prices have gone up 20, 30%, in the last year, you start losing money very quickly. So that's just an example of what happens in oil field, but it happens in a lot of different sectors. But I wanted to pull this one on the screen, the MLPs. I know exactly what this gentleman is talking about. I don't know the exact rules around it, but yes, that is something you have to be weary of. If you have too much of an MLP, mass limited partnership.
If it's under $1,000, it's fine, not a big deal. But there are a lot of so when it comes to investing in MLP,
$1,000 in income.
Yeah, what happens is you get issued something called a K1, and the way you file it can vary like significantly from different account to different account, how it's treated. 2 a.m. actually messaged me on Twitter. Me and him had some back and forth. Like, he gave me some freaking great ideas. I gave him an idea, and this is what it is. Like, a lot of these things, I hate to say this, they're all out there in front of us, but they're locked away in terms of knowledge by the people who make money by telling you how to do stuff or managing your money. One of the games that I think that's been played in finance is, oh, I will manage your money for you. Give me a percentage of it. And they're doing literally just moving one thing to another and using the knowledge that they have to basically just, invest in. And they're literally sitting back just like a parasite, just taking a little bit off the top from your gains, essentially. And it's kind of interesting because you could do it yourself. You don't need them to do it for you. You can structure these funds yourself. You could buy this stuff on the open market yourself. Like, they're not anything super magical special about them, so it is what it is. Like here's an example. Like Meet Kevin, he created the PP ETF, right? The expense ratio is like 0.77. It's almost a fucking percent of the assets managed. Like, that's nuts. So I think the fund right now has like $40 million. That means that he's getting close to 3 point something million dollars passively without having to do anything. And all he's really doing is putting companies in there like Tesla. He's got Enphase in there. He's got I think it'll show you what he has. There you go. He's got Tesla. He's got Enphase. He's got Apple, Nvidia, Ubiquity, Trade Desk. You could manage this yourself. You could just buy those same companies, put it in a portfolio, and save yourself the return that you would have given Meet Kevin. So it's very interesting. Now, on the other hand, if someone wants a very hands-off approach and they're fine with that expense ratio, fine. Go ahead. Let Meet Kevin decide. I mean, then again, he does do a good amount of research from what I can tell. He's not a bad investor by any means. So that's not knocking him personally. I'm just saying that this is all over the market right now, where you're having these ETFs with crazy expense ratios, and all they're doing is just investing in the same companies that you could have invested in yourself and managed yourself without really doing anything, and basically not had to pay them any expenses. That's why companies like VT, tickers like VT, are awesome in that it gives you this huge level of diversification. And the expense ratio is like little to nothing. It's freaking awesome.
Well, I do want to kind of shut this down. I know that we Decided to go on a quick chat, but we've had some good questions. Please, if we didn't get to your question, please leave them in the comment section. It'll be something that me and Chris can kind of look over time. But I did want to answer this particular or discuss this particular piece. This gentleman talked about JetQ paying $350 monthly. He's just trying to grow his account. And I'd say take a look. Chris and I talked a little bit about this yesterday about trying to get too aggressive on the income side. And I think you have to look at, and maybe we'll do an entire video about this or podcast about this. I always talk about, and it's going to sound like very scripted, but it's something I've honed over the past 10 years. By no means am I an expert, but it's just my experience. 5 key things. What's your objective? What's your time horizon? What's your risk tolerance? How active or passive do you want to be in these investments? And how much are you contributing, right? Every single month, or if you're not contributing at all those things kind of have a spectrum within them, right? You could go 0 years, you want the money tomorrow. You could go 20, 30 years, you want generational wealth. But all of it depends on each of those 5 questions. And if you say something like, I want dividend income and I want the money tomorrow, I'm already retired, I don't want to look at it ever, and I don't want to add any more capital, that's going to be very different than somebody who says, hey, I have $1,000 and this is the only money I'll ever have. I'm a quadriplegic. And unfortunately, I have no ability to make money. I live off of, let's just say, special income from the government. And this is the only $1,000 I really want to get just to $2 million. I have no additional money. I have all the time in the world, right? You're going to invest that money very differently. And they all have different objectives, right? If you're just trying to retire, trying to supplement $30,000 a year, and you have that ability to kind of direct the way that you invest your money versus somebody who maybe you're very hands-on, maybe you're a craftsman, maybe you're a handyman, maybe you're a plumber. Flipping houses might be something for you. Versus me, I work a 9 to 5. So flipping houses on the weekend, does that sound very enticing to me? I'm lazy. You know what I mean? So you have to structure your portfolio in a way that makes you sleep well at night. And if for some reason you're losing sleep, it's probably something where you either have to learn how to withstand the volatility, but that might also be saying something like maybe volatility isn't something that you really enjoy. So either 1, you need to stop looking at it, or 2, stop looking at your investment, your portfolio, or 2, maybe you're investing in the wrong things. Maybe you just invest in the S&P 500 and walk away and don't look at it ever again and add money monthly, right? So all these certain things, there's no right way to invest, right? It might sound very fancy what Chris Patel does, but Chris does a lot of damn research. And some of you guys, this might be the only 30 minutes or 40 minutes that you dedicate a week to listen to something, and you just happen to listen to this. And then you're going to go off for another couple months and not listen to anything about finance, in the next couple months. Then investing the way that Chris does isn't going to work for you, because Chris puts a lot of damn time into what he's doing. So you have to tailor your investment strategies for what's right for you. It's why it's called personal finance. But anyway, I'm going to end my segment there. Chris, if you have anything to add, and then we'll talk to everybody tomorrow.
Yeah, you know what it is? Investing is going to be, investing has to be done at the personal level. No matter how much you want to shy away from that and you think that there's some sort of cookie cutter method that's going to be able to be profitable for you, there's so many factors that come into the market. Like, is this for your retirement? Is this something, are you in your 20s and you're looking to build a portfolio? What is your risk tolerance? Are you what income bracket are you part of, right? Which state do you live in? Which locality do you live in? Because even like depending on from one zip code to another, it could be a difference in how you pay taxes, right? All those things factor in your total rate of return at the end of the day. And so I think a lot of times, a lot of people want to have like this one system that just works for them. And no, it's not necessarily the case, So yeah, like I would say there's actually even really freaking amazing opportunities in the market, and you have to know when those are. And there's some times where you just have to sit in cash. Believe it or not, that's like the hardest part for most people when it comes to patience. Someone said, Chris, you're not a patient person. You sell your stocks too often. And I say to them, look, I'm a very patient person. I sit in cash a lot because I wait for the really good deals to come to me. I don't I don't wait. I don't just buy stuff hoping that it goes up. I wait, I do the research and say, you know what? My cash could actually be utilized for this to return me a much higher rate of return without the risk. So right now, I'm up considerably this year, and it's because I sat in a cash position for quite some time. Now that money wasn't yielding me that much money the entire time, and everyone could have said, "Oh, Chris, you're being stupid, man. You could have been in this market." Well, yeah, but I could have also drawn down and lost 50% of my money, and then had to have the market recover 100% just to get my 50% back, right? So when things are like overvalued, things are just going crazy. You should know how to basically, I don't want to say time the market, but you know how to move into the safer parts of the market and wait it out until things are a lot better. And then after that, you can ride the market much higher. And that's what happened with SLG. Luckily, I had a lot of liquidity on me. I was able to buy a really good position in SLG. I'm glad for all the people that bought SLG on our followers, on the finance junkies, and everything. I still get messages from people like, look, I had no idea that this was a thing I could do, that there's actually companies that pay you monthly for just being, shareholders. And I'm like, yeah, this is what happens. A lot of this stuff is just about knowledge. And so if you don't want to commit the time to the knowledge part, by all means, follow us. We'll explain as much as we can, without boring the shit out of you.
And
I can't guarantee that though.
And it might fit into your strategy, it might not, but I think I'll end on a Warren Buffett quote, I think it was, where it's like, imagine you're a baseball batter and you have 10 strikes, and every time you swing, you lose, obviously it's a normal strike. And that basically is thinking about 10 different investments that you could do before you strike out. You'll perform way better than if you had unlimited strikes, because you'll actually have to put a lot of thought, due diligence, and wherewithal within each individual investment, versus if you just have unlimited investments. And that's part of the problem where I think it makes it so easy. There's no, at least in the US, we're lucky to not have any commissions. Basically, everything's free now. Back with like 10 years ago, it was $7.95 a trade. I just watched it go from $15 a trade down to $7.95, and now it's $0. Like, that's just so amazing to think about. But I'm sure Vitaly will probably tell you something about when it was like $50 a trade and you had to call a broker, and God knows what. E-Trade wasn't around back then. But hopefully this was helpful. Chris, any last thoughts, and then cut it off?
No, thank you guys for coming on. We're trying to grow this thing. Hopefully this will be a little bit more serious in terms of like investing. The finance junkies, we kind of like take a little bit of a fun tone, like a boys hanging out talking about stocks approach, where I think me and Matt are going to be a lot more like in depth when it comes to like companies' financials, how the company is performing, what are some of the things that the company at the company level that are doing. And so it's going to be a much more like focused kind of like investing thing. So I would say finance junkies are fun. It's interactive. You're getting 4 different perspectives. You're getting perspectives of someone who's barely been in the market like Amit. You'll get guys like me who are somewhat seasoned. You get guys like Vitaly and Carlos who've probably got the most amount of experience in the market. So these are all the things that you'll get with them. For this one, me and Matt, we're high income earners. I'm not gonna, that's a humble brag. I'm sorry, but I'm gonna just say it because our investing style is dependent on that we have this excess cash flow, and that we can use that excess cash flow to reinvest it in things that may end up panning out to be some of the best things going into the future. So by the time we're in our 40s, we'll pretty much be done working, and maybe this will be something that we do full time, you know. So it's just something to think about.
It's definitely, some people are like, what would you do? It's like, well, I'd probably be on YouTube a lot more. But yeah, that's definitely part of hopefully growing something and having a presence to be able to do that. I love helping people out. I love doing shows like this. All right, man. Yep. Well, I appreciate it. Let me know in the DMs if you have any thoughts about tomorrow's topic. But otherwise, I'll keep it up in mind, and we'll talk then.
Yep. All right. Take care.
Enjoy the rest of your dinner, guy.
Bye.
Cheers.